Hello everyone and thanks for joining me in Fundamental Signals. Today I'm going to talk about McDonald's and I'm going to show you why it might be the good time to buy this stock. Alright, first let's take a look at price versus cash flow. The price over cash flow compared to its 2-year average right now is sitting at minus 0.73. Okay, what does that mean? Looking at the stock history, whenever the price over cash flow dips below 0 or -1, ideally, we basically see that the price is dipping. So that's where you have the bottom and then you get the rally. You can see that in this chart. The time that is this indicator give a green signal, you're basically at the correction phase, and then you have rally going up, and then for example here up. Now McDonald's has been in a uptrend for a long time since it's been out there for public to trade. It's just going up. The question might be asked, how do we know price to cash flow is important, and how do we know if we buy it at the green zone, at the undervaluation zone of the price over cash flow, it's actually beneficial to us? Let's take a look at some of the history and some of the backtesting. Okay, so if you were to DCA the stock when the price over cash flow was below -1 compared to its 2-year average. So this is basically below -1 of the standard deviation. And you waited until it would go above 1, right? It would get a little bit overvalued, okay? Let's see what would have been your return. This setup that I just explained to you happened 67 times in the history of McDonald's since we have data. And on average, if you were to trade this setup, you would have gained 14.7%. Okay. Now, out of that 67 times, 4.5% of the times, 4.5% of that 67 times, you would lose money. But 95.5% of the time, you would gain. You would not lose money. Okay, so 10% of the time you would gain between 0 and 5%. 34% of the time you would gain 5 to 15%, and 50% of the time you would gain more than 15%. And the average wait time for you for this setup to play out is 342 days. Okay, all right. So this was the stats for when you buy it, when price to cash flow is at undervaluation. Let's see what would have happened if you were to buy the stock when it was overvalued, meaning price to cash flow versus 2-year average was above 1. And let's say you were to hold the same amount of time that you hold in the first setup, 342 days. 342 days. So remember, you would have gained 14.7%. Now, let's see how much you will gain. In this case, if you were to buy the stock at the overvalued based on P to S ratio, P to cash flow ratio, your average return would have been 7.7%. So your average return for the same hold time is half in this setup. And there's a higher chance for you to lose money, as you can see here, right? So you would lose money around 27% of the times. In the other case, it was only 4.5% of the times. Let's take a look at another indicator, and this one is P to E ratio versus 2-year average. Okay, we see the same thing when you go below -1 we are undervalued and the price is in correction, so it's a good time to buy. Right now we are at minus 1.1. The price came down from, I think, $350 all the way down to 285. 285. All right, let's take a look. What would have happened if you were to buy the stock, DCA into stock, when it was below 1, and let's say you would sell it when it goes above 1 in terms of P/E ratio? This setup happened 137 times in the stock history. You would have gained 21% on average after 328 days of wait time. The chances that you lose money in this setup is about 5%, right? These are all percentage of the loss, of the times that you would lose. And 95% of the times you would win. With 69% of the time in this setup, you would get more than 15%. You would get more than 15% after 328 days of waiting. Okay? Okay. Keep that in mind. Let's take a look. What if you were to buy the stock when it was overvalued based on P/E ratio, and you would wait the same number of days, 328 days. Okay. Now your gains went down to only 9% for the same average wait time. And you would lose money, 28% plus 13%. Around 40% of the times you would lose money if you were to trade this setup, right? So it's better to get into McDonald's when the P/E ratio versus 2-year average is below -1 standard deviation, and that's where we are right now. We just dipped below -1. Again, the price can go lower. This is just telling you this is a good time to start buying, right? This is an opportunity. You can DCA and you can expect better return than if you were to buy here at the top. Well, obviously, right? But how do we know we are at the top? We can take a look at P/E ratio versus 2-year average. Lastly, McDonald's give you dividend. Now let's take a look at this stock from the dividend yield perspective. And again, we are comparing the dividend yield versus 2-year average. Let's see what happens. Right now, the dividend yield going above 2 standard deviation versus its 2-year average. And historically, that means it's undervalued. That means people start buying. Money gonna flow into stock because the dividend yield versus 2-year average is juicy. People like it. Okay? So that's basically where usually stock bottoms. Now, let's see. Right now, it's going above 2 actually. Let's say the condition is you buy it above 2. Let's just, for the consistency, let's say you start DCAing when it's above 1, right? And let's say you sell it when it's below -1. This setup happened 99 times in stock history. On average, you would have gained 23.5%, 423 days of waiting in this setup. 7% of the time you would lose money, the rest you would win. With 60% of the time you would gain above 15% after 423 days. What if you did not look at this? You did not notice that, and you bought this stock when it was below -1 and waited the same amount of days, 423 days. So remember, the return was 23% in the first scenario. In this scenario that I just explained, your return would go down to 9% on average, with high chance of you losing money. Around 25% of the time you would lose money in this case. Okay? All right. So overall, I think McDonald's is getting to the place that you can start buying in if you have money, if you like dividend stock. It could be a good investment right now based on dividend yield, based on P to E ratio, based on price to cash flow. Okay? All of these are giving us green signals, and we just checked historically how the return is after a certain period of time and how the return would be if you were not looking at these indicators and you would just buy the stock just because you like it, right? So it's telling us that it's time to buy, and you can wait for a year and expect around 15 to 25% after a year. It's a decent return. Yes, it's not fancy return like you would get from other stocks right now that you can go up, I don't know, 600% in a month. But this McDonald's is solid. It generates cash. If you are looking for some safe asset to buy and hold for a year, get an average return, like get a dividend, I think McDonald's is the good stock right now based on the price correction it had and based on the metrics that we just discussed. Okay? All right. I hope you like the content. Please subscribe to my channel. Please give this video a thumbs up, and I'll see you next time.